to the Allan Small Financial Show. Thank you, as always, for taking the time out of your busy day to spend it with us. We have another information-packed show for you again today. As always, we're going to touch on a lot of the questions I've been getting from individual investors. A lot of questions are regarding this boom in technology, this AI boom in particular, all the stocks that are related to artificial intelligence and how they've been really carrying the stock market. Should you be looking at these stocks still at this point in time, or are these stocks, way too high at this point, and perhaps you should be looking at some other ideas? So we're going to talk a bit about that and many other things. And we can pull up our list for our show today. Here it is. So we're going to start off by talking about the Federal Reserve. Some people think that the Fed needs to act sooner than they are talking about right now. There's a lot of talk that the Fed will not cut rates at all this year. The Fed says that their base case is for one interest rate cut in and around December or at the end of the year. The market is being hopeful, I should say, and pricing in a cut come September, but we'll have to see. So we'll talk a bit about what people are saying and what's going on and my thoughts on that. As always, the top 3 things for individual investors to consider over the next 10 business days. What ideas or investment concepts should you be considering before you choose what goes into your portfolio? Markets keep hitting new highs. It's unbelievable. This past week, the S&P 500 surged past 5,500 points. This was last week, I should say, and pulled back from there a little bit towards the end of last week. But overall, the market keeps hitting new highs. What should investors be expecting in the second half of the year? And should we be anticipating a bit of a slower market, or maybe even a pullback in the markets? We'll touch on that. Top 5 things investors should be concerned about. Now, this is different than the top 3 things that investors need to know before you make your investment decisions. These are ideas, these top 5 ideas are ideas that I have that concern me over the next, let's call it, second half of the year. What could derail this market? What could bring down the market from its all-time highs? 5 things to focus on. We'll touch and explain all of those. We went through a poll. There was a poll done on Americans and Canadians, what the families in the United States and in Canada are worried about right now. And a lot of them are saying that obviously their finances are an issue, keeping up with what's going on, keeping up with rising costs, just maintaining their current position in life is a bit of a challenge. I'm going to talk about what I'm seeing and why I'm actually seeing something a little bit different. And our new segment that we introduced last show, it's a segment on quick hits. These are just 3 ideas that we're hearing a lot about in the media recently. And we'll touch on 3 ideas that many of you probably have been watching and seeing on the news. And we'll give an opinion on that. And lastly, your questions. If any of you have any questions while watching the show today, please put them in the chat box. I'd be happy to answer them at the end of the show. If I don't get to them at the end of the show, then I'd be happy to answer them on the next show or during the next 2 weeks before our next show. So without further ado, let's move on with the show. So there are many people out there that think that the Fed is making a mistake, that they should be lowering rates sooner than what they're indicating. Mohammed Al-Arian from Alliance, for example, Allianz, I should say, over in London. He's a very well-respected economist, investor. He used to be in charge of PIMCO, one of the largest bond portfolios in the world today. Years ago, and he moved off to London, and now he's been coming out recently and saying that the Fed needs to move sooner than they're anticipating to be able to maintain this whole idea of having a soft landing. We don't want the market to have a hard landing and crash and burn, of course, into some sort of recession. We want the US market, and therefore the Canadian market, which we tend to follow our neighbors to the south, to have a soft landing. And he believes that the Fed is not going to move fast enough, that they will not cut rates fast enough. And first chart that we have here, a chart that we show quite often, you can see here that what the Fed funds rate is right now, again, 5.25%, 5.5%. You can see a steep incline there in the chart and a bit of a flat flat line at the top. And that's been basically the last, let's call it maybe 12 months almost, that the Fed really hasn't moved on interest rates. We have a next chart here, which shows exactly that. When the Fed raised in 2022, how often they raised in 2023. Last time they raised, yes, just under a year ago. In July, they raised for the last time. And so we're coming up on the 1-year anniversary of the Federal Reserve's last interest rate increase. And so many people are starting to say, okay, well, we're not getting any more increases. When is it going to be, or when are we going to see the first decrease in interest rates? Our next chart here shows the CPI, Consumer Price Index, which shows the inflation rate in the US. Just came down on a recent reading, 3.4% on core, which is less food and energy, and 3.3% on the headline number. So when you look at where the Fed funds rate is at 5.25%, 5.5%, you then compare that to where the inflation rate is at 3.3%. There's a pretty large cushion there, a cushion that we tend to not see. The discrepancy between the Fed funds rate and where inflation is tends to be the difference tends to be a lot smaller. And now plenty of room for the Fed, in many people's opinions, to begin cutting rates as soon as perhaps September. But I think a lot of the economic data coming out in the next couple of months will go a long way to tell us as to what the Fed will do in September. And I'm sure we'll get a lot of signals from Fed officials and Jerome Powell himself over the next couple of months, telling us what they believe will happen in September and for the second half of the year. As I said, off the top of the show, a lot of talk is about one interest rate cut, and that not coming until the end of the year. We have a quote as well by a famous economist, chief economist, Claudia Sam, New Century Advisors. And she wrote that her baseline case is not to see a recession, but it's a real risk. And I do not understand why the Fed is pushing back. I'm not sure what they're waiting for. The worst possible outcome at this point is for the Fed to cause an unnecessary recession. Sam also said that Powell and his colleagues are playing with fire and should be paying attention to the rate of change in the market, in the labor market, I should say, as a potential harbinger of danger ahead. Waiting for deterioration in jobs gains, as Powell spoke of last week, or I guess a few weeks ago now, is dangerous to do. So she's focusing on the rate of change, and that's that's an important thing and an important point to consider. The rate of change. If Jerome Powell and the Federal Reserve governors wait until we see a 2.5% inflation rate, that might be too late to start cutting rates. We might see issues starting to percolate underneath the economy and issues for the economy. We're already seeing issues in areas like real estate. We're seeing growth in the United States slow down. Jobs growth has shown some slowdowns in certain areas. We're seeing job openings slowing down. So we're really starting to see a slowdown overall in the US economy. And to me, if they don't start to move on this, and if they decide to move on this too late, yes, I agree with this economist and Mr. Allan and what they're saying with respect to a harder or not seeing a soft landing. One thing I will add, in my opinion, with regards to inflation, inflation, the definition of inflation is too much demand chasing few supply. And at this point in time, and we're not seeing that issue. We're seeing a lot of supply. We're seeing a lot of supply, for example, in real estate, and that's a problem. Too much supply and not as much demand. And that has been a problem that the banks have been talking about, the central banks have been discussing, and that's about too much supply, not enough demand. We're seeing a reduction in price of goods on the retail side. Retailers cutting prices, Target, Walmart, Costco. A lot of retailers now are cutting prices. So the issue is not about not having enough supply to meet demand. These stores are actually cutting prices to get rid of the excess supply that they have. So there's no longer a supply issue. We're also hearing this from some of the restaurant chains like Starbucks, McDonald's, Burger King. These are all businesses that are cutting their pricing. They want to see more people coming into their stores and buying what they have to offer. So once again, in my opinion, there is not a supply-demand issue. Supply is plentiful. We have enough supply right now in the system to offset whatever demand that we have. This was a problem that we had a few years ago coming out of obviously the out of COVID, out of the pandemic. We did not have enough supply to meet the strong demand, but now that has all turned. The supply chain issues that we have now been cleared for the most part, and now we have enough supply. And in fact, too much supply because, as I said, a lot of businesses are cutting price. So another thing that, in my opinion, the Federal Reserve should be looking at, should be listening to some of these CEOs, the bank CEOs, Bank of America telling us that individual consumers are continuing to spend money, but they're looking more for bargains. They're looking for cheaper items than they were before. So a slightly different consumer than we've seen in the past. When in the past, we just saw the consumer buying anything and everything. Now they're being a lot more selective, looking for bargains. So overall, I tend to agree with some of these individuals, some of these analysts, economists. I think if the Fed does not act soon enough, then we could see a harder landing than what is being set up at the current moment. But it's that push and pull, right? The Fed's going to do what they're going to do based on the economic data. If the economic data were to soften, if we were to see inflation come down, I think they could cut rates more than one time this year. But if the economic data stays strong, stays hot on CPI, PCE, personal consumption and expenditures, another measure that we're going to see shortly, this is, in my opinion, what the Fed is going to focus on. And depending on the data, that is how they will react. Now we come to part of the show that we have on a regular basis where I talk about top 3 things that I think individual investors should consider before they make their investment decisions over the next couple of weeks. Number 1, as you can see here, investors starting to chase the hot stocks. More and more, I'm receiving calls and emails, messages talking about what's going on in the tech space and artificial intelligence and what's with this name, NVIDIA. People can't even pronounce it, to be honest with you. They don't even know at times what the stock actually does, what they do, that they produce chips for artificial intelligence, but they just know they're considered an artificial intelligence stock and they want to buy it no matter what the price is. And they're looking at all the chip makers and all the different tech companies and looking at just chasing these companies to the moon. They don't care about valuation. They just want to get in. And so I think you need to be mindful of that. Second thing, along the same lines and stemming from investors chasing hot stocks, would be stay diversified. It is very important for individual investors to stay diversified at this point in time. You don't want to have all your eggs in one basket. You want to be nicely diversified. And last, or the third point, economic data. We always want to look to the economic data. As I mentioned in the last segment, briefly, we're going to get 2 pieces of economic data in the next couple of weeks. This Friday will be PCE, personal consumptions and expenditures, which is a measure of inflation in the US. Interesting enough, the data will come out on the last trading day for the quarter, on the last trading day for the month, on the last trading day for the first 6 months, the halfway point in the year. So it could be potentially a big market mover come this Friday. And we're also going to get, not this Friday, but a week Friday, we're going to get jobs data in Canada and the US. Obviously, a very important number. We want to see job growth, but not too much growth. That Goldilocks type of scenario, not too hot, not too cold. So let's talk about the first point, which is investors chasing the hot stock. And I thought we'd start off with, you see here, the AI. I thought we'd start off with probably the hottest stock on anyone's list, which is NVIDIA. We have a chart on NVIDIA. And I thought this chart to be quite interesting. This is roughly a 1.5-year chart. It starts on January 2023 up until now, so 1.5 years. You could see NVIDIA in the last 1.5 years up over 800%. 800%. Stock trades somewhere around 45 to 50 times forward earnings, so getting pricey once again. At one point, not too long ago, it was trading, in and around 40 times earnings once it started to really gain some momentum with its earnings. Another chart that we have on NVIDIA showing once again how powerful and how much NVIDIA has gone up with respect to its revenues. Look at these numbers are in billions of dollars. Their net income in billions of dollars. So revenue on the left-hand side and net income on the right-hand side. And the results have really soared, really, since the talk about artificial intelligence, since Chat GPT came out onto the scene, and many people started wondering what this all was about. NVIDIA came out and said, we have the best chips in the market today, and that has proven to be correct. They still dominate the marketplace for artificial intelligence, and it is an unbelievable stock. It's been an unbelievable performer. Actually, I want to go back to the last chart just briefly, if we will. And you're going to see here, even though NVIDIA has been up 800%, you see the line at the bottom there. That's the S&P 500. And one would say, well, it's a pretty flat line there. But understand that the first line is 100% return. So you could say that the S&P 500 is up 40, 50% in the last year and a half. Unbelievable for the S&P 500 to be up that much in the last 18 months. But yet when you compare it to some of these tech stocks like an NVIDIA or like some of the other chip makers, it's not even close to comparing. These chip makers are blowing it out of the water. NVIDIA is just unbelievable. And so when you compare it to the S&P 500, it's just really no comparison whatsoever. Let's fast forward again to what I wanted to look at, which would be the Mag 7, a chart on the Mag 7. I think that it all started with the Mag 7. And again, this is the area that people are chasing, right? They want to buy the big cap tech names. And as I've said all along, and as I will say right now as well, I think you need to own some of the big cap tech names as part of a growth portfolio, but you just don't want to chase some of these names at all costs. You don't want to chase some of the big tech names at all costs. And you can see how well the Magnificent Seven, that actually includes Tesla, which unfortunately hasn't had the best run as of late. So which names out of these big cap tech names can you look to buy today that aren't exactly as expensive as some of the other ones? And I go to three names, two names that are quite cheap, and one name that I think has tremendous momentum and I think is going to go higher, even though it's not as cheap. First name I want to bring up is Alphabet. I've talked about Alphabet or Google many times on the show. You can see here the chart has been tremendous. It has performed extremely well, really, since last November. So the last, let's call it 8 months or so. It's been a great performer. But again, stock trades 23, 24 times forward earnings. Not that expensive when you look at what its growth rate is doing right now. Another name that I've spoken about, again, on this show many times is Meta, or formerly Facebook. Again, another name trading at 23 times, 24 times earnings, growing at a much faster clip. There's talk that Meta is going to have some sort of contract with Apple and be announced shortly regarding their artificial intelligence. And there are a lot of talk right now with Apple and Google, or Apple and ChatGPT and Microsoft, and Apple and Meta. All these big cap tech names getting together to bring us, the consumer, the investor, all the information and the ability to use their products and provide us better, faster, and stronger products. So it's interesting what's happening. And Meta, I think, will be rewarded if they were to get some sort of deal or make some sort of deal in that capacity with any company down the road. But overall, Meta's business is fantastic. As I've said many times, almost 3 billion people are on Meta apps every day. And we know there's only, 8 billion in the world today. So you're looking at almost half the world on their apps at any given point in time. Lastly, Amazon. A name like Amazon, not so cheap, trading at a high valuation or higher valuation, valuation in and around where NVIDIA is trading, maybe even a little bit higher. But I think Amazon has a lot going for it right now with its AWS, its cloud business, its obviously retail business, artificial intelligence. It's got everything, and it's got tremendous momentum. I think this name, for those of you that can handle the risk of owning a name like Amazon, I think this name does go through $200 a share and beyond at some point in the not so distant future. So overall, I think you need to own some of these big cap tech names. But in my opinion, I just don't think you need to chase some of these names. So if you see stock prices really moving far to the upside, stay disciplined. Stay with the ones that make sense from a valuation basis, good quality names, but stay disciplined. Second point on our list of 3 that I think individuals should consider before you make your investment decisions is this idea of diversification. You want to stay diversified. Yes, tech, like in 2023, is leading the way in 2024, but you never want to put all your eggs in one basket. And for those of you that don't have, a big enough or large enough portfolio to go out and buy names in all the different sectors of the market, names or buy different corporate bonds, provincial bonds, money market products, ETF, bond ETF, stock ETFs, basically build up a portfolio diversified in many different areas. Well, the way you do it is to manage product, ETFs or mutual funds. Our first chart here is a pie chart, and it's just an example of what mutual funds do. So they basically divide up the basket of money that they take in, and they'll buy some real estate, some government bonds, emerging market stocks. They'll buy some large cap Canadian stocks. They'll buy some middle of the road sized companies, domestic bonds, international stocks. So through a mutual fund, you can be nicely diversified. So for all those that have smaller portfolios that want to stay diversified to protect their portfolio, because we know diversification is the best way to protect a portfolio, not having all your eggs in one basket, having it in a few different or a bunch of different baskets makes sense, right? If something goes down, the hope is something else in the portfolio rises. And with a mutual fund, that definitely is the case. So you tend to see mutual funds, depending on what type of mutual funds, but for the most part, mutual funds do not move as quickly as individual stocks will. Overall, they tend to move a little bit slower. They are diversified in many different areas, depending on the mutual fund that you buy. And it's always a good idea to be diversified. The next, chart that we have here is one on Gilead Sciences. And this is a name that I wanted to bring up because I get a lot of individuals that own stock portfolios with me, for the most part, stock. They may own some bonds as well. But they'll say to me, Allan, why do we have any names in pharmaceutical? With the exception of Eli Lilly, which has done tremendously well this year. They'll tell me, why do we own a name like Gilead? Why shouldn't we take that money and buy something in the tech space? Because that's moving a lot quicker. Well, I guess they have a point there. But then you get a point in time like Gilead. Gilead had, unfortunately, not the greatest run for the past year. And actually, the next chart we can show, let's go to that chart just quickly before we go back to this one. You can see the slope has been to the downside for the last year, no doubt about it. But you can see here on the far right of this chart, a nice steep rise in share price. Now, if we go back to the chart prior, this is a 1 month chart, and you can see definitely the Gilead. Let's go back one chart. You can see the rise and how pronounced it is. There it is. And they came out recently with a drug in the HIV space to manage HIV. And obviously, it's in its infant stages, but it garnered a lot of attention. The stock went from low 60s to mid 70s in price in a matter of 2 days, 2 trading days. So my point in bringing this up is you never know when a stock is going to have its day. And at any point in time in 2022, tech stocks were the dog of the investment world. Nobody wanted to own them. Tech stocks were falling because interest rates were rising, and tech stocks tend to be interest rate sensitive. Well, in 2023, tech stocks were the best sector to be in. And 2024, tech stocks have done extremely well as well. So you never know. And so the idea to stay diversified, if tech stocks falter in the future, maybe pharma and bank pick up the slack. If pharma and bank are faltering, maybe tech stocks or retail stocks or oil stocks do well. So it's always good to have a diversified portfolio, even when names represent good value, but haven't, hit their stride yet, haven't showed their potential yet. You got to stay with those names, especially if they're good quality. And the last chart I have here for this, which is this whole idea of diversification, is a chart about sector performance, the S&P 500 sector performance. You can see here all the sectors, or many of the sectors, if not all the sectors of the S&P 500. A lot of green numbers to the right, 1-year numbers. S&P up 24.5% on a whole. But you can see consumer staples up 7%, materials up 11%, industrials up 17.5%. 43% gains for S&P information technology sector. So you can see all these different sectors that I believe investors, wise investors, savvy investors really want to be in if you have a nice diversified portfolio. The last point I wanted to touch on that individual investors should consider, as I said off the top of the show, is economic data. We're going to get economic data, PCE, coming out this Friday. We're going to get jobs data coming out in, I guess, a week Friday. And we have our first chart on PCE. You can see here, which is personal consumption and expenditures. It's a measure of inflation. It actually doesn't factor in real estate or dwelling or housing prices as much. So I think the Fed likes this one a little bit better. You can see it's popped up to 2.7% from about 2.3%. But the interesting thing or interesting stat here is that PCE averages over the last, well, this chart shows it, or since, I guess, coming up from 1960 to 2024. So what is that? That's about, let's call it 64 years. PCE averages about 3.3%. And here we are at 2.7%. So below the average. And so I think the Fed is happy to see PCE coming down and staying down. The next chart we have here is on jobs. I wanted to throw that one up. We've seen this before. Last jobs in May, 272,000, above expectations. But as I've said before, jobs is one of those things that I don't think the Fed minds seeing job growth. I think we can have inflation come down while job growth stays strong. And as long as we don't see wage inflation with that job growth, and I don't think we will, I think wage inflation is coming down. I think obviously we have a lot of people coming into the US, coming into Canada, which has helped, perhaps distorted some of the jobs data, some of the jobs numbers, and maybe even some of the inflation numbers as well, with all the immigration coming to North America as a whole. But overall, I think we can still see good jobs numbers and still have inflation come down. So overall, those are the three things I think individual investors should be considering before you make your investment decisions. And as I said, we're going to get some good economic data, some good data points. You know, you got to stay diversified and don't chase those high-flying stocks. Stay disciplined, stay with good quality. And if you do that, I don't think you can go wrong. Markets keep hitting new highs. That is true. We just saw it cross 5,500 on the S&P 500 last week. And who knows where the markets will go in the future. The main thing I wanted to discuss here is that, number one, what we're seeing this year looks a lot like what we saw last year. And that worries me a little bit, because when you have one area of the market dominating as much as we have right now, which is your big cap tech names, it can get a little top heavy. And at some point, when there is a disappointment in either some of the big cap tech names, you could see the market pull back. A couple of interesting stats to tell you. When you look at the S&P 500, you look at Apple, you look at NVIDIA and Microsoft, what I call the trillion-dollar trio. All three companies over $3 trillion in market cap. They represent 21% of the S&P 500. Three stocks make up 21% of the S&P 500. NVIDIA alone makes up a third of the growth of the S&P 500 this year. So the gains on the S&P 500, 1/3 of that is just due to NVIDIA alone. Quite a powerful thing. And we have a chart here of the S&P 500 showing you the gains. And all out of that, as I've said, has been led by technology. The second chart we have is the NASDAQ, which again is swayed more to tech than anything else, although there are some pharmaceutical companies there. So we can show the NASDAQ chart coming up. There it is. And you can see how well the NASDAQ has done as well. The next chart we have here is also a chart in the tech space, Invesco AI, next generation software ETF. Again, showing you tech. Tech has definitely surged. The point, I guess, in me bringing up this about market highs is I think investors have to be prepared for a pullback at some point in the markets. And I'm not saying it's going to happen this month or next week or maybe in 3 months. I'm saying it will happen. And it's healthy when it happens. So if we do get a 5% pullback like we saw in April of this year, I think that's a good thing. And that's something that investors should not be afraid of. I know in April, I had a bunch of calls telling me, well, should we sell? Is the market going to go down? And everybody was nervous because they hadn't seen a down month for really for the last 5 months. And April was the first month in 6 that was negative. We do see down trends in any given year. We do see market pullbacks. We do see corrections in any given calendar year. This is normal. So if we do get one at some point over the next 6 months before the end of the year, understand exactly why. That markets just don't go straight up, that you will see a pullback. And in many cases, this is a buying opportunity to get into some of your favorite names, some of the good value, best value names on the S&P 500 or in the stock market in general in North America, all the indices, opportunity to get into these names at a cheaper price. And so corrections are there and should be used as opportunity, not to be fearful. So yes, markets are meeting reaching all-time highs on a regular basis, but don't fear that correction. That will happen at some point. I would embrace it and say, how can we use this as an opportunity? And I think if you do that as an investor, you will be quite successful. So this is a list I have here, top 5 things that I think individual investors should be concerned about, not to the point where it causes you to make any investment decisions or go against some of your investment decisions, but something that I think everybody should keep this in the back of their minds, a list to keep in your back of your mind. And these are 5 things that I've come up with that I think that it's possible if any of these things happen, it could derail stock market and its performance, meeting new highs on a regular basis, as we seem to have in the last, for the first 6 months of this year. If any of these things were to happen, I think it could be a negative for the stock market. And here are the 5. An overheating U.S. stock market, which we're starting to see. Federal Reserve too slow to cut rates, which we've touched on already. U.S. elections. We're going to have a U.S. election in November of this year, and I think there are risks to both candidates. Geopolitical issues. We had a guest on our show, Matt Gherkin, last show, talking about the relationship between China and the United States and that tit for tat, the rhetoric going back and forth between the two countries, and how we both, him and I, think that this is a major issue and can be a major issue for all of us and the stock market. And not to mention a lot of the geopolitical events taking place around the world, the wars in Ukraine and Middle East. So a lot of geopolitical issues that could pop up in the coming months. And last but not least, I put it last on the list for a reason, because I'm not sure it's going to happen. But if oil prices were to surge once again to go well above $100 a barrel, how would that affect the stock market? So these are the 5 issues that I think are important to focus on. So let's take each one of them briefly and go into it. The first one, overheating U.S. stock market. Our first chart here is on the S&P 500 PE ratio. And you can see it here. You can see the chart. We can pull it up. S&P 500. You can see a spike. There's our spike in 2000 and right before the financial crisis, actually. The end of 2000, 2007, 8 time period, we saw the financial crisis. The PE ratios on many of the stocks came crashing down, and we started to pick back up. And we saw a bit of a downturn, obviously, during COVID, 2020 timeframe, and then spike higher in and around 2022, 23, and came down and back up again. And so what does this tell us? Well, this tells me that the S&P 500 right now, you're trading in and around, well above the 20 times earnings mark. And usually S&P 500 trades somewhere around 18 times, especially when interest rates are lower. When interest rates are higher, like we see now, many people believe the S&P is stretched, overstretched, trading at too high of a multiple. So you want to be mindful of that. If this stretching of this S&P 500 or the stock market in general continues, it's something to be possibly concerned about. Now, I will say, obviously, as we know, a lot of this is because of the tech names. There are many names that aren't stretched, that still represent good value. And that's where you want to be, in my opinion, in this market. You want to own a few of the tech names, but you want to look for those names that still have not gone a lot higher. So overstretching of the stock market on a price multiple earnings basis is something to keep in the back of your head. The second one, we've touched on this, Federal Reserve too slow to cut rates. And One of my favorite charts of this show is the next chart that we have, and this is U.S. policy rate and recessions. And it's interesting because it compares what the Federal Reserve is doing in terms of interest rates. There it is. And right after those shaded areas are recessions. And you can see very clearly that every time interest rates move significantly higher, it's followed by some sort of downturn in the market or recession. And here we have on the far right-hand side, another spike in interest rates, but we have not seen that recession or downturn in the market as yet. Will it come at some point? This is the fear that many people have. And that's why I have the fear that if the Fed doesn't cut rates soon enough, that it's going to be too late and we might get into a downward period for the stock market. So that's why many economists are saying the Fed needs to look at the rate or the rate of change versus the actual number itself. If we see numbers going up slowly or slower than before, or even in a decline, that is far more important and a bigger signal than the actual number itself. The number still may be at 3%, but if the rate of change is definitely getting smaller and smaller, that should be good enough for the Fed to cut rates. The third point, I mentioned U.S. elections. Obviously, the current president, President Biden, will be going up against the former president, President Trump. And we've talked about this briefly in other shows. It'll be a very important event, obviously, to say the least, for the economy, the stock market. And the one thing I wanted to show in our next illustration here, we've had this illustration up before, and just to talk about, so the S&P 500 index returns in U.S. presidential election years. And you can see here that overall returns at all election years, the return of the stock market is over 11% average. That's phenomenal. And maybe that has something to do with why the market's doing so well this year. When a Democrat is elected, 7.6%. When a Republican is elected, 15.3%. And you can see here the third point or observation, when a Democrat was in office and a Republican was elected, the total rate of return averaged almost 13%. So when you get a Democratic president, as we have now, replaced by potentially former President Trump, that would, on average, look to be the best case scenario for the stock market. Now, obviously, there are risks on both sides. Former President Trump wants to increase tariffs. The current President Biden wants to increase taxes. There are pros and cons to both, I'm sure. But overall, history has told us if you have a current Democratic president replaced by a Republican one, that tends to be the best scenario for the stock market. And I guess last but not least, when you look at, I should say, second last point, I should say, we have one more after this, the geopolitical scenario, geopolitical issues around the world, as I mentioned. This is, again, that tit for tat between China and the U.S. We know the U.S. just recently put tariffs, slapped larger tariffs on a lot of the imports out of China, up to $300 billion worth of goods coming into the U.S. will now have higher tariffs. We have an illustration here that will clearly show the amount of tariffs that are being added to the current tariffs that President Trump put on a lot of the Chinese goods. You can see here, electric vehicles, 25% tariffs originally, now up to 100% tariffs. Semiconductors going to 50%. Solar cells, syringes and needles, all up to 50%. Lithium, EV batteries, 25% from just 7.5%. This is what the United States is doing with Chinese imports. And it is, you can see here, $300 billion worth of Chinese imports. What will the Chinese do? They've already retaliated with a number of measures on their side. And the worry is that this could continue. If the U.S. were to continue with certain tariffs or other measures against China, not sending over their best chips to China, China will retaliate in due course back and do certain things to what they send to the U.S., or perhaps limit what some of the businesses can do, like Apple, like Starbucks, like some of the chip makers and tech companies in China. What could they do to these businesses to I guess, extract a bit of a tit for tat? They didn't do this from the United States. They put tariffs on our exports. We're going to do certain things to what they sell us or what China gives to the United States. So geopolitical events, in my opinion, is something. And again, as I said, That doesn't even, we haven't even spoken about what's going on in the Middle East and Ukraine. Obviously, those are massive events that have gone on now for quite some time. And if there's any change in the Middle East and what's going on, or change in Ukraine, then that could obviously cause an issue for the stock market as well. So something to keep your mind on, to keep in the back of your mind with respect to geopolitics. Last but not least, as I had on our list, is the price of oil. I think if oil were to spike based on geopolitical events, or based on cutbacks by OPEC, or a spike in demand for oil around the world, if oil were to hit maybe $100 a barrel and go beyond once again, what would it do to inflation? I think inflation numbers would start to pick up all around the world once again. Things would be a lot more costly. And so oil prices, I have it fifth on the list. I don't think we're going to see a big spike, but anything is possible. There could always be an event to cause a spike in oil prices. If that were to happen, I think that could perhaps slow down this current market rally. So 5 things to keep in mind and put in the back of your mind as we move forward with our investment decisions, creating our portfolios. These are things that I believe will unfortunately remain in the background for quite some time, and hopefully they don't come to the forefront. So a recent poll showed that there are many Americans and many Canadians that are worried about their finances. They're worried that they're just not going to be able to stay at the same economic status as they have now, that their finances are deteriorating, that they're just having trouble keeping up with the standard of living. And it's a problem. And in the US, 46% of individuals, I'm reading the survey right here, are saying that they're struggling financially, according to this Monmouth University Polling Institute. In Canada, we're hearing through public opinion, 55% are worried about their personal day-to-day family finances. So we're hearing a lot about that. We have a chart on those 2 things. Canadians' financial anxiety rises. This is an interesting chart, and it shows us how I will be worried about my personal and family day-to-day finances. The yellow is showing us not likely, and that's starting to come down. The blue line is starting to rise, which is likely. And even the purple line, very likely, is starting to rise as well. Not a good sign when we see Canadians really becoming fearful of their personal financial situation. In the US, we have a chart, the next chart here, showing that, 46% are struggling right now, 45% are stable, and 9% are improving. So we love to see category in the US. Then we have right now stable 45%, and struggling is just way too high, 46%. And so when people ask me, am I seeing the same things as these polls are showing? I tend to say not necessarily. And the reason for that is, and I've touched on this on other shows, the people I see, the investors I see, tend to have obviously money to invest. They come to me because they want to build a portfolio for their future, for their retirement, for their, to put their children through university or college or post-secondary schooling. These individuals tend to have money saved up. So when times are tough, as they are now, when we see a rise in costs and a rise in pricing, when we see a rise in taxes, a rise in tariffs, all these things are really causing overall cost of living to go higher. Those that have invested and have assets and have investable assets, portfolios, they're able to use those portfolios to perhaps draw some money from those portfolios to make things a little easier today. And so, as I've said many times, those that live paycheck to paycheck that unfortunately don't or are not able to invest, they tend to have a more difficult time in these types of environments than those people that I see, which are those that tend to have money to invest. And as I said, you can draw down on your investments if you need to perhaps pay a little bit off that higher mortgage rate that you have now. You can draw down on your investments to perhaps pay off some bills that you have, to pay for your kids' schooling. Even though things and costs are rising, you have that ability to draw down on your investments. So I guess the main point here to me is, if you can, you want to be an investor. You want to invest for your future. You want to invest to make your life better in the future. And so, yeah, I don't tend to see a lot of individuals that we see struggling that are in these polls. I do talk to many of them. You can be someone who's struggling and still have investments, but usually those that are struggling, they don't want to draw down on their investments. And unfortunately, they have to at times. So yes, their retirement savings may be a little less, but they're able to handle the current times a lot better than those that don't have investments. So this is a new part of our show that we introduced last show. It's basically quick hits, we call them. And these are three things that you may be seeing in the news right now, things that are making the news. And I'm going to comment on just a few of the ones that I've noticed. CFIB urges government to scrap the capital gains tax. We know capital gains exemption tax has gone higher. Inclusion tax rate has gone higher. And a lot of small businesses, according to CFIB, Canadian Federation of Independent Business, the head, Dan Kelly, who's been on our show several times, is now saying that small businesses are really going to struggle under this higher inclusion rate. Keep in mind, just to refresh everyone's memory, right now, 50% of capital gains is taxable, 50% is non-taxable prior to this recent increase on the 25th. And after the 25th, rate goes to 67% is now taxable versus before we had only 50% of capital gains being taxable. So a big difference, especially for business owners. Calls for the US and EU tariffs on Chinese EVs. I know that the Premier, Doug Ford, he was a leader in calling for this. And so we'll touch on that. US and Canadian retail sales starting to show some wobbling. Yes, retail sales are coming down, consumer not buying as much and focusing more on cheaper goods. So let's delve into these very quickly. CFIB, we actually have a quote from Dan Kelly, which we can put up. And this is a quote regarding capital gains tax changes. Half of Canada's small business owners will be hit by the new 66.67% inclusion rate, hiking coming on June the 25th, which obviously just passed. And warns Canadian, and Dan Kelly is warning, warning the government that this is obviously not good for small businesses. With the details of the changes in the inclusion rate only coming out in the last few weeks, business owners were only given 2 weeks to make informed decisions, leaving virtually no time to change gears. And details of the proposed Canadian Entrepreneurs Incentive have yet to be published, leaving entrepreneurs largely in the dark on potential beneficial changes. So what Dan Kelly is saying, head of CFIB, these changes or this idea of raising rates, raising the inclusion rate on capital gains just came out. And unfortunately, a lot of small businesses will not be able to do much before obviously we're not able to do much before the deadline, and obviously not a good thing for small business. Second quick hit that I think many people are discussing and talking about is this idea of Canada matching the United States and putting tariffs on electric vehicles coming from China. And as I said, the Premier, Doug Ford, again, who was on our show not too long ago, he has been a big proponent of this, saying that the United States has put tariffs, we need to do the same in Canada. And that has been discussed at the federal level. And we'll see what transpires, how this will transpire with respect to the relationship between Canada and China. But an interesting chart I wanted to show about this, we have it here, total value of imports of electric vehicles. And it's interesting. This is where Canada imports its EVs from. And you can see here that China is the biggest, has the biggest growth. Percent change from EVs from China is almost 1,300%. Much larger than any other country. Mexico, 500%. Maybe we'll have to do something on Mexico as well. But overall, China, 1,300% growth in electric vehicle imports. So quite large. So something that we're hearing about, and as I said, something in the news recently. Last but not least, we wanted to touch on our third quick hit is this idea of retail sales slowing down. And we have a chart on this one as well. Canadian retail sales monthly change. You can see here in Canada that in May, it actually went downward. We actually had negative retail sales. We're expecting a positive number the next retail sales reading, but overall, there is no doubt about it that we're seeing retail sales in Canada slow down. People tend to spend, but they're definitely spending less and on cheaper items. We have some retail sales numbers out of the US coming up here. There you have it. And you can see here that retail sales in the US also were slumping over the last couple of months. Again, expecting a better number in June. But overall, I think you can tell that the consumer is not spending as much. And we know that the consumer makes up at least 70% of the economy in the United States. And the consumer makes up a very large percentage of the economy in Canada as well. So another quick point that retail sales are coming down. I guess you just have to talk to anyone that you know that owns a business, a retail business. They'll probably be the first to tell you that, yeah, times are a little bit more tough today than they were maybe just a year ago. Now we come to the part of the show where I like to try and take as many questions as I can. Usually we only have time for one question, and that's the case today. Our show, as always, seems to be running later and later or longer and longer as I try to bring out more and more information to all of you, the investors. So I'll just take one question that I have. I have a few here. Here's a question. How do interest rates affect bonds? Is now a good time to buy bonds? And it's interesting. We talk so much about stocks. We don't talk perhaps enough about bonds, and maybe I should, on one of the upcoming shows, have a segment on just bonds itself. But yes, interest rates do affect bonds. As interest rates rise, bond prices drop, and as interest rates come down, bond prices go back up. So right now we've gone through a scenario where interest rates have gone up, and so what we're seeing is interest rates up, bond prices down, and so you can buy bonds very cheaply and earn a higher rate of return. Right now, we're seeing short-term bonds paying higher than longer-term bonds. In fact, the actual yield curve, as we call it, is actually inverted. You could buy a one-year bond or treasury, government treasury bill or money market, and actually you can see it's paying higher than what a 2-year is paying or a 5-year or a 10-year. So that's not normally the case, right? Normally paying higher interest than 1-year bonds. But overall, as interest rates come back down, which hopefully they will continue to do so, we're going to see bond prices go up. And that will mean yields on your bonds and money market funds and other things will come down with it. So you have basically a couple of choices today. Do you lock in, maybe buy a longer term bond at maybe a 3-year bond, maybe at 4 or 5%, thinking that interest rates are going to come down. So at least you get that rate for a 3-year period. Or do you stay really short term and I guess ride the interest rate wave down a little bit over the coming year or two? And that's the question I think individual investors need to ask themselves. So with that, I want to say thank you to all of you once again for tuning into our show. Hopefully all of you gained some information or can take something away from what we brought to you today. I want to thank you for watching, and I want to say hopefully all of you will tune in again 2 weeks from today, which will be July the 10th at 12 noon, which is obviously a Wednesday. And until then, happy investing.